Okay, fantastic. So we're now recording and we're going to take a look at task 5 on the ABBK First Intuition Mock 1. So before we get into any sort of specifics with the actual questions, let's just take a look and have a look at the components of what is involved in this. What are you likely to be doing in task 5 in your advanced bookkeeping exam? So we're told that this is about control accounts, the extended trial balance, and any adjustments and reconciliations. And just as a bit of general info, it's worth 20 marks, and according to the AAT statistics, this would mean you'd be looking to spend around 24 minutes on completing it. Now, again, that's not absolutely by the book. It's just how the AAT apportion time based on the amount of marks available. But of course, you will know your own strengths and subsequent weaknesses. So in terms of what's actually going to be going on in these tasks, we have a nice little debrief here. So first of all, we're told that you will be presented with an extended trial balance that already has the ledger balances and adjustments completed, which is very, very nice. So essentially the initial trial balance will already be done for you. Now you will be intimately familiar with this from your level 2 studies on bookkeeping transactions or bookkeeping controls, for example. You've had plenty of experience setting up the initial trial balances, so that isn't what we're going to be looking at here. We're basically going to extend it, as the name suggests, and we're going to put things, as you'll be familiar with, in the relevant statements, be it the statement of profit and loss or the statement of financial position, when we've taken into account any sort of adjustments. So as we go through this, we're going to sort of revisit the ever-present anagram dead click just to see how we can identify what's going where. And as we can see here, we're basically going to identify income and expenses appear on the P&L, and then any other items such as assets, liabilities, capital drawings, they're going to appear on the statement of financial position. So the devil in these questions is in the details. There's a couple of things we need to be wary of when we're working on an extended trial balance, and we'll address them individually as we get to them. The first one is, of course, putting things in the right statements. It goes without saying, but you only need to put 1 or 2 items in the wrong statement, and it is going to cause haywire, and you can lose a lot of time in the exam backtracking, trying to find those errors. And a mistake a lot of people make is trying to remember where all the individual descriptions go. So I know sales goes here, purchases goes here, the sales ledger control goes there. That isn't necessarily the most efficient way of doing this. And again, we're going to look at that in a bit more detail this evening. We're going to look at identifying what sort of account we're working with. So again, I'm working with an asset account. I know assets belong in the statement of financial position and so on. That's the trail of thought that we're going to start using here. So basically it says to us, we don't need to remember all the individual details. If we can identify the type of account we're working in, we know just by the product of association, the relevant statement it belongs in. So we're also being told that we're going to total the profit and loss columns. And as it says here, they will not and should not balance in the first instance, because what we're also going to be doing when we fill in this extended trial balance is inserting the profit or loss figure. So the balanced amount will be the profit or loss for the year. As we can see here, if a profit has been made, you would need an extra debit to make the column balance. This is the profit for the year. And again, we'll have a look at that a little more in a minute. The other side should be entered in the statement of financial position as profit for the year. So we debit the profit and loss account and we credit profit on the statement of financial position. Again, we will see that as a visual reference shortly. And then, of course, if a loss has been made, we're going to do the opposite. Stands to reason, doesn't it? Obviously, with profit or loss. So whatever a profit is, the entries for a loss are, of course, going to be the opposite. At this point, when everything is in, the columns should balance. And if it does, happy days. We should be have smooth sailing from that point onwards. We are also told about control account reconciliation. Now, in this task, truthfully, the extended trial balance will be the much larger section and probably where the lion's share of marks will be made available to you. But you will more than likely also be asked to perform some other sort of functions, one of which, as it says here, is control account reconciliation. Now, this isn't anything particularly new to you guys. You can track some of this back to bookkeeping controls when you're looking at things like errors, or you're working on a bank reconciliation, or you're working in reconciling a purchase ledger control account or a sales ledger control account, or perhaps even a VAT control account. That isn't anything particularly new to us, but we've got to make sure that we're still showing the AAT we have fundamentals of that knowledge. And then with that in mind, we're now going to make a start. So as we said, we're going to touch on those points. We're going to go through this bit by bit, break it down into nice little chunks, and then pick up some useful tips along the way. So, as we know, this task is about the extended trial balance, adjustments, and then reconciliations. So we're basically told use the following information to complete the table below to show the 3 adjustments you need to make to the purchase ledger control account. We're then told the balance on the purchase ledger control account has been compared with the total of the list of purchase ledger accounts, and the following differences have been identified. So very quickly, before we go into the specifics, we've got information we can work with. So first of all, there's going to be 3 adjustments. Some of the work has already been done for us. The following differences have been identified. So we've already had half the job done for us. We aren't trying to root out these errors. We're going to make the appropriate adjustments for them. So we got adjustment 1, which is telling us that a contra entry of £785 has been included in the purchase ledger control account, but had not been included in the purchase ledger. We've got number 2, which says the total column in the purchase returns day book was overcast by £279. Number 3, total discounts received of £899 were only recorded in the discounts received account. And then the final one, number 4, was that a purchase ledger column of £1,950 in the cash payments book was not posted to the purchase ledger control account. We're then told the balance showing on the purchase ledger control account was £12,850 and the total list on the purchase ledger balances is £10,020. Okay, so we've got a lot of information there that we now need to pick through. The first thing that we always need to sort of identify is what account are we working in. Be very, very careful you don't slip up right from the get-go, because again, we've heard discounts are received, purchase ledger control account. Make sure you know what account you are adjusting in. We are told in this question, we're making changes, or making adjustments rather, into the purchase ledger control account. We need to know that. It's so easy to get this mixed up. Don't fall into that habit. Make sure you very clearly know what you're working on. So it stands to reason. We've got 4 transactions. There's 3 adjustments. So we need to root out the one that simply we don't need to do anything with, don't we? That's the first instance. So again, the basic way we can do this is run through them. Let's apply a bit of logic. Can we identify what would not be required to be adjusted in the ledger control account? So we look at number 1 again. So we have the contra entry of £785. So that had been included in the purchase ledger control account. It had not been included in the purchase ledger. So the question is, do we need to make an adjustment for this? And the short and sweet answer is no. And the reason? It's already been included in the purchase ledger control account. So this is why it's important that we identify what we are working in. Where are we making these adjustments? We don't need to make an adjustment for this because we're already told it's included in that account. So very, very nicely, the first one we've looked at very clearly states that no, it can't be that. And the other thing is, with a question like this, we've now rooted out the one that it isn't. So we automatically know that 2, 3, and 4, these have to be adjustments, don't they? Because the question is looking for 3 adjustments. So just by doing a simple process of elimination, we've not had to run a logic check on all of these. We found the wrong one. Fortunately, it was number 1. And we now know what our adjustments are going to be. So before I start looking at specific amounts, I'm going to write adjustments for transaction 2, transaction 3, and transaction 4. Okay, so we've sort of put half of it together now. We found out what needs adjusting. We now need to make the double entry required to actually post these adjustments, don't we? So again, this is where we start to expand on what we've just looked at in terms of making sure we know what account we're working in and we know what amounts we are dealing in. So we're dealing with the purchase ledger control account. We know that. So essentially, one of 2 things is happening here, isn't it? If an entry's been missed or it's been input incorrectly, either the amount in here is going to be too low or it's going to be too high, isn't it? Depending on what it is, depends on the double entry. And this is why it's important that we understand what account we're working in. So let's just quickly look at the purchase ledger control account itself. We know this shows the total amount that we owe to our credit suppliers. So it's a liability, isn't it? We know it's a liability, and we know that generally when we buy goods on credit, we express it as a credit entry in the purchase ledger control account. So what we're going to say here we're going to make an adjustment in the credit entry side if our amount is too low. If we need to increase what we owe, it's going to be a credit entry. And the opposite, if we need to reduce our liability, if the adjustment we're going to make is going to reduce that amount, that's because, of course, our liability will simply be too high. So this is why it's important we identify what account we're working in, because if we get this in the wrong account, it's going to cause a lot of issues. So just to emphasize there, any entries that are going to go on the credit side mean that originally the amount in the purchase ledger control account would have been too low. Any on the debit side mean the amount in the purchase ledger control account would be too high. Okay, let's take a look. So we know transaction 2 was the total column in the purchase returns day book. That was overcast by £279. So straight away we can pick up easy marks. Let's transpose that figure over. And then let's apply the logic that we have just had. So we're saying that the total in the purchase returns column was overcast. So it wasn't omitted, it was overcast, which means we've overstated how much discount we've received. So consider the original entry if you were recording the amount in that purchase returns. So when we would have recorded that, as we've sort of touched on, we'd be reducing the liability, which would be a debit entry in the purchase ledger control account. If we have put too much in, we've overcast, we need to now increase our allowance again, our total liability again, don't we? Because the amount we've posted is making the balances too low. So with that in mind, it has to be a credit entry to increase our total liability. Let's have a look at number 3. Total discounts received of £899 were only recorded in the discounts received account. So again, let's move that amount over, £899. So again, let's apply the same logic. So we're told this time that there is a discounts received. It was only recorded in the discounts received account. There's been no entry in the purchase ledger control account, which basically means that, again, the amount in there would be too high, wouldn't it? This discount should reduce our liability, should reduce what we owe to our suppliers. To do that, we simply need a debit entry. And Natalia's pointed it out there very nicely. Thank you very much. Number 4, purchase ledger column, £1,950 was posted in the cash payments book, not posted in the purchase ledger control account. So again, let's put that amount in very nicely. And again, let's just make sure we're checking the devils in the details with these sorts of questions. What are we working in? We've got that column, we've got the amount, and it's in the cash payments book. So again, a very common mistake people will sort of see is they'll sort of see something missed from a purchase and they instantly think, oh, well, it's going to be a credit because I'm going to increase what I owe. This is a payment. We paid the supplier, haven't we? We're actually reducing what we owe them. So if we wanted to do this normally, we would, of course, credit the bank account when the funds leave. We would then debit the control account, wouldn't we? So the fact we haven't done this means that the amount would originally be too high, which means that when we post this adjustment, it's going to be a debit entry for £1,950. And that is the sort of logic we need to apply with these questions. It does sound a bit long-winded, and of course we're going through this at a steady pace, but once you start to understand the link between what a missed entry will do or something that's been omitted or duplicated, you can put those links in place. The rest of the adjustments, it just falls under what is pretty practical bookkeeping that we've seen quite intimately up until this point. Okay, let's have a look at part B. So part B is a bit of an interesting one here. So when we're talking about reconciliations, just a bit of a general question here, which is about the net pay control account, or it may be called the wages control account. You may see it referred to as that in some resources. It's basically the same thing. So again, we've told which of the following statements about the net pay control account are correct. So it stands to reason we're going to go through these one at a time, find the true answers. There may be 1, there may be 2, there may be 4. So let's go through these bit by bit. So for number 1, we're told that the net pay control account shows the net pay due to each employee. Now, the clue is in the name here, isn't it? So if you think about your other control accounts, like your sales ledger control account or your purchase ledger control account, that doesn't show the individual balances from supplier to customers, does it? So the wages or the net pay control account isn't going to show the individual amounts due to each employee. It's the control account, it shows the total. So that isn't true. The net pay control account will be debited when the employee is paid. So for this one, you can quite literally go back to your bookkeeping controls resources from level 2, and you can basically reaffirm this. It is true, because the double entry we would do is, of course, just think about it, money out, we're paying, we're going to credit the bank. So of course, we're going to debit that control account afterwards to show that that payroll has now been paid, essentially. Number 3, the balance on the net pay control account will summarize the total cost of wages to the business. Now, again, this is one of those where you'd have to revisit your resources just to make sure you've got all the nitty gritty. This isn't actually true. What the net pay control account shows is your gross pay plus the national insurance contributions. That's not an N, excuse me. That's the national insurance contributions. And that's your total cost. It doesn't show that. Make sure you take the time to see what is actually included. And again, you'll see that it's your gross pay, excuse me, plus any sort of employees' national insurance contributions. That is the total cost to the business. The net pay control account doesn't actually show any sort of pay as you earn, national insurance contributions, or any other sort of liabilities like that. And then for the last one, the net pay control account should never have a zero balance. Ooh, interesting. What are we saying there? So we're saying that when we have this control account, the balance should never be zero. Now, this isn't true, is it? Plain and simply, because obviously we're recording our payroll. It should at the beginning or at the end of a payment period, this should be cleared off. When we look at a payment period, so we pay people every month, that is the payroll for the month, isn't it? We're going to close that off. We aren't going to have at the end of the year a net pay control account that has the payroll liabilities of the entire 12 months. Of course, that is something that gets recorded in the P&L. So a bit of a tricky question, that one, to be completely honest with you. A bit of a curveball. It's, like I said, it's something that has come up more predominantly in level 2, but it is about those reconciliations. It's just sort of get you into the framework to start to understand what's coming or what may be coming up in your exam. But we know why we're really here. We all know what we're really interested in, and it's this big, meaty, extended trial balance. So this is where the marks are going to sit in this question. So as we sort of looked at when we looked at the briefing, the initial trial balance, which is your ledger balances here, is very kindly already been prepared for you. All we're going to do is take into account the adjustments and then transfer things over to the relevant statement, be it the profit or loss or the statement of financial position. So a couple of things that we need to point out and be aware of before we go any further here. The first one is the role of the adjustments and the role that they are going to play for us. So we're basically told here the adjustments have already been correctly entered. That's great. So everything in these adjustments, we don't need to do anything with them. It might not always be the case in your exam. You may make some adjustments in like part A, for example, and then you will manually post them here, something that you do need to be aware of. But in terms of the adjustments, we need to consider how they impact the amount that gets transferred over to the relevant statement. And what I mean by that is you've got debits and credits, but what happens if you have an original balance that was a debit on the ledger balances and the adjustment is for a credit? How do we deal with this? Short and sweet, there are 4 different calculations. And when I say calculations, it's literally going to be an addition or a subtraction. So when we're working on these, I'm just going to scroll down quickly. If we have the initial balance of a debit and we have the adjustment of a debit, we're going to add those two together, aren't we? So a debit plus a debit will get transferred over to the relevant statement. If we have an initial debit, but the adjustment is a credit, we're going to deduct it. You can probably see where I'm about to go with this. If we have an initial balance that was a credit, any debit adjustments will be taken off. And then equal to that, if we had an initial credit again, we would add on any credit adjustments. So just to confirm, these are the initial balances. These are the adjustments. Sounds quite straightforward, but again, you'd be amazed at how easily people can slip up on this, mainly because of the amount of information that is readily available to you. When you're looking at a trial balance like this, there's a lot to deal with, to be completely honest. You know, you've got lots of information in lots of different columns. It can be very easy to trip up and just misread a number or add when you should have subtracted. So very, very, very easy marks to drop, but also really easy marks to gain if you just keep a sharp eye out. So let's just reaffirm that. Make sure you know what your initial ledger balance is, and then add or subtract the adjustment based on what we've just looked at there. And we're going to see that in practice now, because I don't like saying it, to be completely honest with you, because it sounds like a lot of waffle. It's like debit, add debit, credit. It sounds like a lot. It sounds like I'm sort of stuck. I'm like a printer that's jammed and I'm stuck on repeat. So we're going to see it in action here. So let's just check the formatting as well. Let's just have a quick run through this. So we're being told to extend the figures into the statement of financial position and the statement of profit and loss columns. We're told do not enter zeros into unused cells. Make the columns balance by entering figures and a label in the correct place. Now, it might sound silly, but this is the sort of formatting that is very possibly going to come up in your exam. They don't like having lots of zeros on the trial balance. The main reason for that is because it's messy. As I sort of just touched on, there's a lot of information that we're dealing with here. If we just chuck in zeros in every blank spot, imagine how much harder it's going to be to pick relevant pieces of information out. It's going to be a headache, isn't it? So we're not going to use them. So with that in mind, we're now going to start running through these. And what we're going to look at is the second thing, and that's identifying the account. So as I sort of said, when we looked at the breakdown, assets and liabilities, drawings, capital, they will belong on the statement of financial position. Income and expenses will belong on the statement of profit and loss. What we need to do is now identify, what is it? Is this account an asset? Is it an expense? And so on. And we're going to do that as we run through these questions. Okay, let's start with the allowance for doubtful debts. So the process we're going to do is find the amount. Are there any adjustments? Where does it belong? So we've got our amount, 3,455. Are there any adjustments required for this? No. Where does it belong? So I'm going to run through a couple of these. If you do want to have a go in the chat as well, please do. Just P&L, SOFP as we're going through these. Now feel free to have a go as we're working through them. So the allowance for doubtful debts, again, this is ones like this catch a lot of people out. Very similar to depreciation. Make sure you know what you're working with. We've got the doubtful debts account. We've got the doubtful debts adjustment, haven't we? Now the allowance for doubtful debts is the liability. So that's the overall liability. The adjustments will be the movement between years, if we're increasing our allowance or perhaps decreasing it. So as this is the liability, as we've touched on, that is going to go in the statement of financial position. That's 3,455. And I do apologise, I will write as neat as I can. These are tiny, tiny boxes, and they only get smaller. I don't know if that's, maybe my hands are getting bigger, but these boxes seem to get smaller every time I do these. So I will make it as neat as possible. Okay, number two, we've got the cash at the bank. £8,750 is our original amount. Is there an adjustment? Yes. So first of all, let's figure out what that adjustment is going to be. So we've got an opening ledger balance of a debit. We have an adjustment of credit. So as we've just touched on, it's going to be a debit minus the credit, and we can do that now. So we're going to take that 8,750 and then take away the 95. That will give us a figure of 8,655. So that is the amount that we're going to move over to the relevant statements. And then again, it's just a case of identifying what that correct statement is. So what is it? It's cash, it's in the bank, it's what we own, it's an asset, assets belong on the statement of financial position. It's going to be 8,655. Fantastic. Number three, capital. Now, the good thing is with this one, pretty self-explanatory if you use this if you use the anagram dead click in a specific way, isn't it? 4,758. Capital, if you look at dead click, we know it belongs on the credit side. Capital belongs on the statement of financial position, and we will see this a lot more as we start to go through level 3. When you look at final accounts, for example, as well, capital becomes a much more important thing. So that's going to be quite easily moved over, 4,758. Fantastic. Closing inventory. Now, closing inventory is an interesting one, and this is something that does catch people out. You'll see that we've got no original entry in the ledger balances, but then we have 2 in the adjustment section for the equal amounts. So basically what's going to happen here, if you aren't 100% sure already, is that we're going to have an entry into both financial statements. Closing inventory is an item that will appear on both. And the reason it isn't in the initial ledger balances is because this is what we call an accounting adjustment. If we're looking at things like accruals, for example, or depreciation charges, these are adjustments. We have seen that in our studies up until this point. There won't be an initial balance. It will become present when we look at adjustments. So that's why there's nothing here. We aren't missing anything, but we do need to be aware. So we've got 2 figures, we've got 2 statements. It just stands to reason that one's going to go in one, one's going to go in the other. We need to identify why. That is the next thing we need to do. How do we know which one has the debit entry? How do we know which one has the credit entry? Now, there's 2 ways to remember this, and it's quite similar to double entry in the sense of if you know where one goes and you're 100% hand on heart certain that it goes there, you know where the other one's going to go. You don't necessarily have to remember both. It's probably beneficial, but it's not an absolute essential part of what we're doing here. So let's look at the statement of financial position. What is inventory? So we know what items belong in the SOFP: assets, liabilities, drawings, and capital. Closing inventory is not a liability. It's what we own. It's the items that we have in stock. So it has to be an asset, doesn't it? So if we're saying that we can regard that inventory as an asset, we know we're going to recognize it in the statement of financial position, 3,567. And Dawn's just pointed it out there, an asset, therefore a debit entry. Correct. Now, because we know where the debit is, we know the credit has to go in the statement of profit and loss, 3,567. But just to give you a bit of context, just so we're not sort of skimming over half of it, the reason it goes on the credit side on the statement of profit and loss is basically it goes on the opposite side of where purchases would go. We regard purchases as an expense. The expenses go on the debit side of the trial balance. Closing inventory will do the opposite, because when we work out our cost of sales, we take off closing inventory, don't we? So we're essentially deducting it from purchases. Fantastic. So what we've got next, we've got depreciation charge for £1,044. Okay, so same again, this is an adjustment. No original entry is required here. And this is where one of the other 2, like with the doubtful debts, let's just make sure we know what account we are working in. Are we working with accumulated depreciation, or are we working with depreciation? Well, we can see, can't we? It's the depreciation account. Where do we record that? In the profit and loss. And I'll tell you why in just a moment. Let's just write that in. So this is the depreciation charge for the year. It is the expense we have incurred this year, not the long-term liability that's recorded on the SOFP. That's accumulated depreciation. But this is where you can start to see where people can essentially get the wires crossed and start to get stuck. Okay, admin expenses. Now, the good thing, I do like these ones because they tell you what it is, don't they? Administration expenses. It's an expense. Where do expenses go? In the profit and loss. Easy peasy. If only they were all that quick and easy. And then opening inventory. So again, a couple of different ways we can look at opening inventory. This doesn't go on the statement of financial position. Consider this within your cost of sales calculation. Again, you've got the opening inventory plus your purchases less your closing inventory. So what we can say here is if we've got the closing inventory on the credit side of the P&L, the opening inventory, just by the simple rules of what we've been working in, it's going to be the opposite. And I'll just reinforce that in the P&L alone, not into the statement of financial position, because it's going to be part of our costs of sales or cost of goods sold. Wages and salaries, again, pretty self-explanatory, isn't it? If it's on here, it's a debit entry, it's an expense. Expenses belong in the profit and loss. Purchases. So this is quite an interesting one. We've got our initial balance. We've then got 2 adjustments, a debit and a credit. we just apply the same logic here. So we'll write this one down just to make it a bit clearer. We've got 15,898. So that's the debit. So we're going to add on the debit balance or the debit adjustment of 640. And we're going to take away the credit balance or the credit adjustment, excuse me, keep saying balance, of £98. And providing we've done that correctly, we should get a figure of 16,440, which will be recorded in our profit and loss. 16,440. So just because there's a couple of adjustments, we don't do anything different. We're essentially just adding another step onto these balances that we looked at originally. Okay, purchase ledger control account. We've got an amount and we've got an adjustment. So we've got £3,098. We then have an adjustment of 478. And we can see that we've got an initial balance that was a credit. We've got an adjustment that is a debit. So we're going to take these two figures away from each other. 3,098 less your £478. That will give us 2,620. As this is the purchase ledger control account, it's a liability. It belongs on the statement of financial position. Fantastic. What about sales? 34,578. What do we class sales as? Again, pretty self-explanatory. Sales is income. Income belongs on the profit and loss. And as there's no adjustments, we're just going to move that figure over nice and easy. So you can start to see the questions we're asking ourselves here. Sales ledger control account. Well, we know where the purchase ledger control account sits. It sits on the SOFP. So the sales ledger control account stands to reason is going to be the same, isn't it? This is our asset. This is what customers owe to us. So we've got a debit balance of 12,567. We're going to deduct the credit adjustment of £800. That'll give us a total figure that we're going to transpose over of 11,767. Fantastic. We are getting there, not too far to go now. So marketing. Now marketing, again, anything like this, wages, admin expenses, marketing, insurance, anything like that is an expense. Okay, just because it doesn't say marketing expenses, don't slip up and don't fall into the habit of thinking that it's something different. It is still an expense. We're going to record that in the statement of profit and loss on the debit side, 1,678. Let me just write that a bit neater. Brilliant. Now this is an interesting one. So this is the last one that's really going to catch us out here, and that's the suspense account. Basically what would happen is when we have a suspense account that's been originally generated in our initial balances, it means that something has gone wrong. The suspense account has been created to make the initial trial balance actually balance. We will then have to find out what that error is, make the relevant adjustments in the adjustment section, and then we clear it. The suspense account should not go on any of our statements. It should not be present on anything. It should be killed off at the adjustment section. Now, the good thing is with this question, they've already done it, haven't they? If you take 929, add on your debit balance of 329, and then take away your credit adjustment of 1,258, excuse me, it actually equals 0. It's cleared. There's going to be no entries in here, is there? We're going to clear it off. And this is a very big point and something you do need to be aware of. You should not have anything in either statement which relates to your suspense. It should be killed off in the adjustment section. If there is anything that goes into these columns, something has gone wrong and one of your adjustments has not worked. Okay, we're nearly there. Let's smash through these last three. So that is always an interesting one. Just be careful. Don't forget, we sometimes regard this as an asset. We might be owed money from HMRC, not beyond the realms of possibility. In this instance, it isn't. It's an initial ledger balance of 3,078. That is a liability. It's on the credit side. It's what we owe to HMRC. As it's a liability, it goes on the statement of financial position. And then we've got machinery at cost, which again, we know this from our previous workings in this unit. It's an asset. We've got an adjustment, but again, we can see the pattern happening here, can't we? Debit entry of 17,500 less your credit entry of 240 means we have a figure of £17,260. And then last but not least, accumulated depreciation. So again, when I'll talk about depreciation, be careful, make sure you know what account you're working in. The accumulated depreciation, as we've touched on, is the long-term liability. Liabilities go in the statement of financial position. Fantastic. So what we should find now is when we total these up, they won't balance, will they? I'm not going to sort of ask you to do it all while we're here, because we'll be here for the rest of the night. But when we looked at the briefing, we said that these figures shouldn't balance. We're going to have a differentiation. So that differentiation is going to be our profit. And we can see that we've got this green space here. We're going to record that profit. Now, profit doesn't go in any of these here. Okay, this isn't an adjustment. This isn't an initial balance. It's just going to be the balancing figure. Okay, so what you would need to do is total up your columns. Find the column in each statement that has the higher amount. Now, just to save us going through all of these, when you go through the statement of profit and loss and you total everything up, on the credit side of your profit and loss, you have 38,145 as a total. And then on your statement of financial position, when you total all these columns up, in your debit column, you have 41,249. So what we're going to say, we're going to have two entries. There's going to be an entry here and an entry here for the same amount, which should then cause everything to balance up. So if we work out the difference between the columns, and again, you can do this in your own time, total up everything in your debit column, take it away from 38,145, you'll find that the difference in figures is 14,538. And when we basically put all that together, so we now total everything up in these columns, we're going to have 38,145. And then again, we will do the same again on statement of financial position. Add all your credit balances up. The difference between the two figures should be the same, 14,538, which means that our total 41,249. Fantastic. Everything balances. All the initial balances are fine. Adjustments are fine. Our statements are fine. And that is it. We've now worked through the extended trial balance. We've overrun a little bit, but we've got through it. This is an important one. And to me, I always used to look at this as a really good area to get marked. Its mark is a lot worse than its bite, in my opinion. People have headaches over accruals and disposals and stuff like that. This isn't anything as nasty as that. If you can nail this extended trial balance, even if you do make a mistake, it happens, you can still pick up a large quantity of marks. Don't forget, 20 marks available for this task. You can still make a couple of mistakes and pick up 17 plus marks. It's a really, really good one to push you over the threshold in terms of what you're aiming for. Okay, so it's 7:10. So we're now going to swap over and we're going to be looking at final accounts. So let me just make sure that I can get this up again and also make sure that everybody can still see it. So can I please just check? You should now be able to see task 4. Can everybody please see that and just confirm that for me? Yes, okay, brilliant, thank you. Okay, so same again. Let's have a nice run through the debrief and then we're going to look at a question. So task 4, I will just write to keep it clear. This is on final accounts. We have not gone back in time. We are now on final accounts, just to make it clear for everybody. So this is about the knowledge and understanding that underpins final accounts prep. And we're told that this task is worth 16 marks. And again, according to the AAT's figures, you should be looking at spending 19 minutes, very specific, to complete this. Take those with a pinch of salt. Like I said, they apportion it based on the marks available in the exam. You will know better than them what you can do quicker and what you might need a bit more time working on. So task 4, now this is an interesting question. What often happens in the final accounts exam is people spend an awful lot of time covering the statements, so the profit and loss and the statement of financial position. You spend a lot of time looking at the appropriation account and goodwill, markup and margin. And what often happens is they come unstuck on a task like this, where we're looking at more of the ethics side of things. Let's just break off a bit. Where can I find recordings of these sessions? So the recording of the sessions is up on our YouTube channel. When we finish, I'll post a link in the chat just so you can access them on there. If there are any that you may be missing, when we send the weekly email out, you can just ask and say, have you got any covering depreciation, for example, and we'll be able to send those over to you. Okay, so as I was saying, these sort of questions are often where people trip up. And it's not necessarily because they haven't done the work or put any effort into it. It's because ethics sort of has this habit sometimes, and you will have experienced this already, where you have a question and then the answer could be, well, it could be A, but it could be B, and you can form a logical argument for both. And you wouldn't necessarily be wrong, but of course in the exam, there's only one right answer. So this is what catches a lot of people out, and this is what we're going to look at in a bit more detail. Just fine combing through things, and we'll just look at a couple of pieces of terminology just to see if we can pick up. And basically what we are going to be looking for is making sure that you're singing from the same hymn sheet as the AAT in terms of regulations and the advantages and disadvantages. You might be right, but make sure that you're right in the sense that you're also agreeing with what the AAT think. You're not arguing your opinion, you're adhering to theirs, if that makes sense. So basically it says here, might be a number of short form questions which test knowledge in a lot of different areas. And again, I won't run through them all specifically, but we've got like the distinguishing different types of organizations. So again, what's the difference between a sole trader and a partnership? What's the difference between a charity and an LLP? Different types of ownership, structures, tax, just like general tidbits that you've seen as you've been going through your studies. We've also got regulations applying to different organizations. Now this one does come up a lot. Things like the Charities Acts, International Accounting Standards, Partnership Act. You aren't expected to be an absolute wizard, and you're not expected to be able to recite the Partnership Act word for word, but you are expected to have a good understanding of the fundamentals of it. Also got identifying the users, final accounts, and explaining their different needs. And again, this is one of those, it's a bit, I'm trying to think of the best word to describe it. GUI is what I like to use, because this is one of those, you'll see when we get to these, you can argue that a user can have it for different reasons, but we need to make sure we pick the right user in the eyes of the AAT. And then we've got understanding the accounting principles underlying the preparation of final accounts, including assumptions such as going concern and the characteristics of useful information. Now we've seen going concern, we've seen how that sits in with the accruals basis, characteristics, fundamental, enhancing, which is which, again, does come up, trips a lot of people up. Make sure you take the time just to reinforce them, because it isn't particularly difficult. It's more about memorization, because the description's relatively short and sweet. So as it sort of says there, actually, it's merely a matter of learning your facts. And again, repetition, it's almost like muscle memory. You know, the more you do this, the more it starts to register in your brain, the more you go through these certain acts, just becomes easier. This isn't technical. Like I said, the technical side is what people tend to focus on, goodwill, appropriation, and so on. This isn't technical like that. This is just knowledge. We've just got to make sure that we've got it covered. So there's a bit in here about sole traders and partnerships, limited liabilities, and limited companies. Now, I'm not going to run through all this because we're going to see this in a bit more detail in the question, hopefully. But this section is just pointing out a couple of characteristics and the differences between them. Again, at this stage, if we're in a revision session, we should be comfortable with the characteristics of a sole trader or a partnership, for example. And charities, just nicely at the bottom. Okay, so let's get into this. So we're told that this is about knowledge and understanding underpinning final accounts preparation. And straight away, we can see that we're faced with a different question. And sometimes this makes people's stomachs sink. I can't see any pound signs. I can't see any debits or credits. To some people, that is bliss. It's fantastic that they don't have to worry about that. But for some people, again, we spend a lot of time focusing on the figures and the debits and the credits. All of a sudden, all that is taken away here, isn't it? So we're going to be tested, our knowledge is going to be tested rather in a different way. So let's start with task A. We're told to identify with a tick Now it says with a tick, in your exam, you'll just click. Obviously, you won't be manually drawing those. Which of the following is not an advantage of running a business as a partnership? And let's just reaffirm that again. Easy marks to drop, not an advantage. Make sure you know what you're looking for. No, oh, excuse me. There's no point having the best fine comb in the world if we're fine combing through the wrong pieces of information and we're looking for the wrong thing. So we've got 4 options. So again, it stands to reason, doesn't it? One of these is going to be a disadvantage. So let's have a look. A partnership is easier to dissolve than a company. Now, this is oddly enough, this is positive, isn't it? This isn't an advantage. It's a bit of a funny one. Now, we don't want a company to dissolve, and it's never a good thing, is it? Let's be completely honest. But in terms of what the statement is saying, it is correct, isn't it? It is easier to dissolve than a limited company. We've got number 2. Individual partners can develop specialist skills. Again, is that a disadvantage? I wouldn't say so. Of course it isn't. The more skills we've got, the better. So as you can see, what we're doing here is simpler process of elimination. Start to apply logic. Is this, what are we looking for? I'm looking for basically a disadvantage. Is this a disadvantage? Is that a disadvantage? Start to ask yourself and just apply a bit of logic to it. We're told that each partner is only liable for their individual debts. And then we're also told that there is less admin setting up a partnership compared to setting up a company. Now, the good thing is with a question like this, what we've essentially done is we can find the right answer by just weeding out the wrong ones. It might not always be this nice in your exam, but we can achieve this. So let's just look at this bottom one, for example. We're saying that there's less admin in setting up a partnership compared to setting up a company, a limited company, excuse me. So that's true. We know that statement's true, but is that a disadvantage? There is less work for us to do. That isn't a disadvantage, is it? The statement's correct, but it's not a disadvantage. So it can't be that answer. Of course it isn't. So the only thing we're left with is each partner is only liable for their individual debts. We know by the process of elimination, we found 3 wrong answers. It can't be anything else. If we want to just apply a bit of theory behind what we've just done, each partner isn't just liable for their individual debts. This statement is incorrect. It's false. Essentially, the official term is partners are jointly and severally liable. You aren't just liable for your individual debts. It doesn't work like that. So by just finding true, false, advantage, disadvantage, this is the sort of process you need to be taking. If you've got 4 answers and you aren't, 4 potential answers, excuse me, and you aren't sure where you should be going with it, weed out the obvious ones first. If it's something you know is absolutely wrong, it definitely isn't that, just take it out of the equation. One less thing to worry about. Okay, let's look at the next part. We're told to identify whether the following statements are true or false. Now again, these sort of questions are pretty nasty, but they do come up, and this is what we need to be aware of. So we're going to have to go through these and basically apply a bit of logic. And in truth, to find a bit more detail, it's more about revision at this stage for you guys, just going back, checking statements, checking previous pieces of information. So let's start. Rules such as how inventory should be valued are covered in IAS 2. Short and sweet, that's true. If you're on your computer, a quick Google search will confirm that is what IAS 2 does. And again, if always these accounting standards and how in-depth you need to be with them, you don't need to be an expert on every international accounting standard. Not a lot of people are. I certainly am not. Just make sure that you are aware of the ones that are relevant to the units you're working in. And again, you don't need to be an absolute expert on everything that's involved in IAS 2. You need to know what it governs. That is the main point. And that ties in with the next one quite nicely, actually. Rules such as what items need to be capitalized and acceptable depreciation methods are covered in IAS 12. Now, again, this is one of those where if you just didn't know on the top of your head, you'd be guessing. But if you can just build a bit of a, previous knowledge, put in place the building blocks, and when you've looked at these standards, make notes of them. IAS 12 focuses on income tax, or income taxes, I should say. So that statement It's false. IAS 16 looks at the items that should be capitalized and acceptable depreciation methods. So again, little ones like that can very easily lull you into a false sense of security because it's basically giving you everything you need to know, but the standard's wrong. Charities are regulated by the Charities Act 2011. Now again, you revisit your notes, you'll very quickly see that is true. Things you do need to watch out for with this is the date of the act. Do not forget that legislation and governing acts have changed. They continue to change. Not every year. There's not a Charities Act 2012 and so on and so forth. This 2011 Act is the most relevant one. But do be aware, if this was the Charities Act from 1962, for example, it's pretty safe to say that in those 60, 50 years, you know, the act's changed. The legalities and the governing of that will have completely shifted, so it wouldn't be regulated by that. And then the final one, sticking with charities, we're told that a charity must be registered with the Charities Commission and be established for charitable purposes. Now again, this is actually false. You're probably sat there going, well, why? Because we've just sort of looked at the Charities Act, we're now looking at the registration and why they should be established. Very easy thing to get slipped up on here is it's a half truth what's in this question. When we say be established for charitable purposes, of course that's correct. We know that it's a charity. It has to be set up for those reasons. The devil in the detail here comes from the fact we're told it must be registered with the Charities Commission. That isn't true. Not necessarily. The majority will be. Basically, the way it will work, I'll just scroll down to give us a bit of space, is for the required registration, is required if income exceeds £5,000. If their income falls below that figure, they don't actually have to register. They can, and any of you that are already on indirect tax, you'll know about like registration thresholds and stuff like that. This is a registration threshold. If they exceed it, yes, they have to register with the Charities Commission. If they don't, it's not mandatory. So a bit of a tricky one that, like I said, it's a half truth, isn't it? It's not necessarily wrong in terms of what it's saying about why charities are set up, but a little statement like that must be registered. Those are the little nuances and the little details that the AAT do like to put in. They want to make sure, can you spot the subtle instances or the subtle pieces of terminology in a question that tweak it one way or the other. Okay, let's take a look at the next one. Which one of the following is not an enhancing characteristic of useful information? We've got comparability, timeliness, relevance, and verifiability. Olivia has just asked, how many marks is this task? I believe it is 16, Olivia. Let me just double check. So yeah, total 16 marks. Always safe to double check. Let's scroll back down. Okay, so Natalia's actually got it, which is fantastic. We will run through these. So the qualitative, was a tongue twister, especially at 7:30 on a Monday, and enhancing characteristics. Again, this is one that seems to cause a lot of headaches when it really doesn't need to. It's like, it's one of those, if you can understand what one half of it definitely is, you understand what the other half also is as well. When we have fundamental characteristics, there are two. I'm just going to make some space here. We have fundamental and we have enhancing. So what are our fundamental characteristics? The first one, which isn't on this question, is faithful representation. The second one, as Natalia very kindly pointed out, is relevance. Oh, that's a very poor line, please excuse me. So those are our two fundamental characteristics. That is it. There are no more that are going to come up. Enhancing quality, enhancing characteristics. Anything else on the list? Comparability, timeliness, verifiability. So when we look at faithful representation and relevance, we say these are fundamental because they are critical. They are a key part of the foundation when we're producing financial statements. Of course, the statements and information we produce, they need to be relevant. Of course they do. And they also need to faithfully represent the position of the company and any sort of events that have taken place. Anything else, such as comparability, timeliness, verifiability, we're not saying these are not important. That isn't what we're saying here. We're not saying these are disregarded. What they are things that will galvanize our statements. They will enhance the quality of them. If we can offer them in a good amount of time, if we can fact check and they are verifiable, these things will make our statements more enhanced. They don't mean it is a critical part of the production of them. So a nice little way to remember that, understand what your two fundamental ones are, and then you understand what your enhancing characteristics are as well. Fantastic. Okay, we are nearly there. We might be 5 minutes late, so I do apologise, but we will just get this wrapped up. Where's the question? There it is, and I've just written all in that space. Okay, let's just clear this. So we've got extraordinary items are prohibited by IAS 1. And then we're simply taught on the next page, the formatting is not particularly brilliant, I do apologise. It's going to be a true or a false question. So again, this is true, and we'll dig into that in a bit of detail, but again, this just reinforces, just make sure you know the summaries of what goes in each statement. So the question is, what is an extraordinary item? That's the next thing we need to just make sure we're aware of. Not something that you're going to be critically examined on, but it just adds, it gives us a bit of context, doesn't it? Applies a bit of fundamental thinking behind what we're working on. So we talk about this. Let's look at IAS 1. So IAS 1 it basically governs the presentation of financial statements, and we use FS for short. Okay, so extraordinary items, again, it's not something that's going to come up, but it would be basically an indifferent occurrence or an abnormal event. So that could be a very large gain or a very large loss that basically isn't generated or did not come from the standard operations within a business. A company getting a big sale is not an abnormal occurrence. It's not an extraordinary item. It's a bit of a funny one, this, and again, I could sit here for another half an hour talking about this. It's something that is basically substantial in respect to the size of the business. Now, again, if if Tesco came into a lump sum of £100,000 through some convoluted method, that's not a significant amount when you consider materiality compared to just Tesco as a whole. It's a penny in the ocean, isn't it? If it's a sole trader or a man with a van and £100,000 lands on his lap for whatever bizarre reason, that is an extraordinary item in respect to the size of his business. So it's something that is relative to the size of the company. And we say, and again, it's a bit ambiguous. It's something that would be rare or unusual. As to what that is, it comes down to the individual's discretion. It's a little bit tricky. But like I said, that's going down a rabbit hole that isn't particularly relevant to you guys at this stage. So let's look at getting these last two questions wrapped up. Part B and Part C. So the concept of going concern can be used in which of the following situations? So again, we're going to do the same, aren't we? We're going to apply some logic here. We're going to run through these. Is there something that's blatantly obvious? Is there something that's blatantly wrong? So what is going concern? And we're basically saying we've got three different descriptions of the terminology here. One of them is going to be correct, at least. There might be more, but let's take a look. So number one, where a business intends to continue trading for the foreseeable future, but with the intention of significantly, reducing its scale of operation. We've got number two, where a business intends to continue trading for the foreseeable. And then we've got number three, where the business, where there is a strong but not definite possibility that shortage of funds will force the business into liquidation. So basically what we're going to do is just recall this goes back to like your advanced bookkeeping, where you first get introduced to the accruals concept and the going concerns concept. What is it? That's all we're going to do. Recall to yourself what it is and then match it closely with the most relevant description here. The going concern is essentially, it's a trail of thought where we make plans and we make actions and movements under the assumption that the business is going to be here for the foreseeable future. So with that in mind, we can immediately eliminate this bottom one, can't we? Because if we're talking about forcing the business into liquidation, that is not assuming the business is going to be here for a significant amount of time. So that's one down. Now, with a question like this, there's two very similar statements here. So it stands to reason that we're only going to be looking for one right answer. The question hasn't told us to tick 2, tick 3, or tick 1, but we can put 2 and 2 together here, can't we? We can see that these are very similar. So one of these is going to have something about it that makes it incorrect. So let's look at the top one. So where a business intends to continue trading for the foreseeable future, but with the intention of significantly reducing its scale of operation. Now, because of that last little bit there, reducing the scale of its operation, that means that statement isn't true. That isn't correct. That is not an accurate description of going concern. We've already said we are talking about trading stably for the foreseeable future. This is a change. It's not something that can't happen. It's not outside the realms of possibility. Of course, businesses will do that. You look at the pandemic that's happened over the last 12 months. Businesses, of course, have had to scale back, but this is change. It's unusual, isn't it? It's a change of the usual. Oh my word, please excuse me. Because it's a change of the usual, it doesn't go in line with the concept of going concern. It simply doesn't. And then process of elimination, we found the right one. It's the most accurate description, the most relevant one. And to be fair, you go back in any of your reading materials or any of your resources, when it will have a statement incredibly similar to that. The business intends to continue trading for the foreseeable. So it's essentially just business as usual. And that doesn't mean that there won't be any sort of change. You know, a company might be a bit busier one year, might make some slight increases in sales, slight decreases in sales. But of course, the difference is here significantly. That is outside the realms of normal change. So that's the subtle pieces of terminology in these questions. Okay, let's do point C. Let's get this wrapped up. We're going to use the pick list to match the users of information to the individuals or the proprietors most likely interested in it. Now, this is one of those, I don't like these questions because they're very gooey. Like I said, you can form an argument that a user would want more than one of these. But what we are looking for here is the most relevant one. So again, most likely, it's most relevant. The most relevant user. I'm going to go into a bit of detail just to see how we get to that. So let's just look at what we've got. We have management. We have employees. We've got investors. And finally, we have suppliers. So we've got 4 individual users of financial information, and we've got 4 pieces of information, haven't we? So it stands to reason that there's going to be one for each, and that each one of these is going to fall. We're not going to have none for suppliers, for example. So let's run through these, and what we're going to ask ourselves is, who is the most likely? Who is going to want this most? Who's going to find this information the most relevant to them? So we've got number 1, interest in profitability and stability of the business. And straight off the bat, this is the sort of question where you can go, well, management and investors. Surely management want to know about the profitability and the stability of the business. Of course they do. But who needs it more? And this is what we need to start asking ourselves. Who wants this information more? Who's it most relevant to? And we can start to apply, bits of information. If we look through everything, we've got management and investors that could fall under here, don't we? So I'm going to put M for management, and I'm going to put an I for investors. So let's find can we find anything else? So one of these needs taken out of here, doesn't it? Can we find out where that other one's going to go? Interested in clear, simple, understandable information. Management or investors aren't going to be particularly bothered about that, or that's not the most relevant thing to them. If they are management, they don't, information needs to be as comprehensive as is required, not simplified. Interested in the financial stability of the business? Again, could be, but the clue is in terms of cash flow. We're going to come back to that. And then we've got the final one. Interested in comparable information from other organizations within the same business sector. So when we look at this bottom one, that is something that management would be interested in. Of course it is, because if they're looking at pricing structures or costing structures, they will want to know what's happening in the market. And if you've got an investment in Amazon or Apple, you aren't particularly interested in the cost structures of other organizations or comparable information from a different mega large company. If you're a shareholder, that's nothing that you're interested in. What you want to know is how much money am I going to make? So that is information. It's actually really relevant for managers. They will need that information that they will use and make decisions as appropriate. So we've identified that management are going to be more interested in that information. We can also identify that it must be investors that would be most interested in the profitability and stability of the business, because what do investors want? Money. They've made an investment, they want a healthy return on it. So the profitability of the business is very, very much in their interest, not what's going on elsewhere, not necessarily how simple the information is. Okay, 2 down, 2 to go. We've got employees and we've got suppliers. So again, we've got 2 left. Can we very quickly identify what's going where? We've got interested in clear, simple information, and then interested in the financial stability of the business in terms of cash flow. Now, the reason I pointed out cash flow is when we just looked at this, you could argue that, well, what's the difference? We've already mentioned financial stability in the first part, haven't we, in number 1. So why are we looking at it again? But we're looking at stability in terms of cash flow. Now, when we talk about cash flow, of course, it's money in, it's money out. Who wants that information the most? Is an employee particularly concerned about what's going in and out of the business? Probably not, perhaps depending on the job role. But if you're working on the shop floor in a bread factory, the cash flow of the business is not your immediate concern. What about suppliers? Well, again, it's money in, money out, isn't it? If we don't have cash to pay people, the first people that are going to be on our backs is suppliers. Suppliers will want to know that information. It is the most relevant for them out of this pick list. And again, this is one of those, you could argue that management would want to know it as well. Of course, management would want to know the cash flow, but again, we're picking the most appropriate one. That is the most appropriate one for suppliers. And then by the process of elimination, interested in clear, simple, understandable information, has to be employees. Now, it sounds a bit rude when we say it like that. It's not about sort of saying, oh, they don't need to, they're not clever enough to understand this, or they're not smart enough to understand that. That's not the angle we're going on here. You look at the relevance of the job roles in sort of the AAT bubble. You've got like your like costing, like your management accounting, where you've got production and things like that. They don't need to know about cash flows. They don't need to know about overheads and anything like that. They will be focused on the job that they are doing. So the information that they will get just needs to be straightforward, doesn't it? What am I doing? What is the relevant information that I need? It should be simple. It should be understandable. If you've got a baker in a bread factory, is a statement of financial position of use to him? No, it really isn't, is it? And with that in mind, we have come to the end. So just to confirm what we've done there before we wrap things up, go through the list, look at your users, try and find the most appropriate. As I said, you can argue the case for 1 or 2. If you're stuck, so you say, well, it could be an investor, it could be a management, go through the rest of the pieces of information you've got. Is there another one on there that you can very quickly say, well, that must be investors? If you can find where that one goes, you've automatically dealt with your first query, haven't you? Again, questions like this, it's really about practice. This is one of those, like I said, it's not technical, it's repetition. Get into the idea of that way of thinking and just get that practice tied in as much as possible. Okay, so with that in mind, I'm just going to hit the stop recording button. I'm just